The very sharp jump in volatility last week has started to wane, but the reality of higher interest rates in the US is dawning on the markets. A quick update on the likely impact here in Australia. The market has been underestimating the impact of higher US interest rates for some time now, or perhaps misinterpreting this as just a reason for the US dollar to strengthen rather than a reason to sell bonds. We continue to suggest US bonds will weaken as their yields keep rising, with the 10-year yield likely to breach 3% in the next few weeks. The hardest part of this equation to solve, however, is the impact on stock markets, especially after the sell-off that started a fortnight ago, coinciding with the sudden jump in US wages, as seen in their recent jobs data. Wages growth had been the missing link between a strong US jobs market and inflation, but this seems to have normalised. So the market now seems to get that official rates really are rising 3 to 4 times in the US this year. And while the related stock market sell-off was dramatic, being a record one-day fall in absolute points, it was less newsworthy in percentage terms. But overall, the stock market lost about 11% from recent record highs in late January to the lows last Friday, which was significant and a sign of volatility ahead, even if it is all just a correction in an ongoing bull market. Higher interest rates will always challenge stock markets, but the trade-off between higher profits driven by the US tax cuts versus higher bond yields equally driven by this stimulus is finally balanced. Eventually, it threatens to overheat the market, but the timing there is the great unknown. While the stock market was falling, the US dollar was gaining value. But now that share markets are more stable, we're seeing US yields rise at the same time that the US dollar is back on the decline, which is helping to push our Aussie dollar higher. The US dollar weakness still appears to be a case of debt concerns trumping the benefits of tax cuts, as well as the better outlook in Europe and rising commodity prices driven by the global growth story. So we still favour a 75 to 81 cent range for the Aussie dollar, with the risks to the top side. The RBA would prefer a lower exchange rate, but will take some comfort in the trade-weighted index remaining well below 67, as it has done for most of the last 3 years. The latest jobs figures and upbeat business confidence numbers have a sense of optimism back locally, despite the volatility from offshore. However, the jobs data did disappoint a little with the bias to part-time work over full-time, hence the fall in average hours worked. This also links to the lack of wages growth locally, which RBA Governor Philip Lowe made clear is a prerequisite to any rate rises here. So it still looks like another 6 months or so of rates on hold, but the global growth outlook may make the world look very different in 6 months' time, especially with volatility back in the markets. See you soon for the next market update from Bendigo Bank.